Hey guys, last night the budget was announced and they have made changes around capital gains taxes and negative gearing. The headlines look pretty scary, so I just thought I'll record this video to decode it for you on what it actually looks like. So I'm just modeling a scenario. So I'll be discussing capital gains first and negative gearing differences later. So the capital gain differences, I've just modeled a scenario here for your better understanding. So I'm comparing both the scenarios, which is the current rule and the new rule that is coming out. We are buying a property at $500,000 today, and we are selling it in 10 years' time at $1 million. For the first scenario, which is the current rule, which is 50% flat discount if you held the asset over 12 months. So, and then the second scenario is where inflation adjusted capital gains, which is going to be the new rule coming into effect from 1st of July 2027. And we have taken an inflation of 4% each year. So currently the inflation is sitting at 4.6, but we have taken an average of 4 here. So now, so what we are asking is that assuming both the capital gains are taxed at highest marginal tax rate, how much is the actual tax difference in the two scenarios? So the purchase price is $500,000. You sell in 10 years time for $1 million in both cases. So your nominal capital gains is $500,000, and we are assuming a marginal tax rate of 47% here, including the Medicare leeway. In scenario one, the 50% discount is $500,000 is your capital gains, and then 50% discount on that is $250,000, which means your capital gains are only $250,000, and being taxed at 47%, your total capital gain tax becomes $117,500. In scenario two, which is going to be the new rule at 4%, the indexed purchase price or the cost base after 10 years becomes $740,100. So the new real capital gains is $1 million minus 740, which means 259,900 as opposed to 250K in the previous scenario. So the capital gains in this case is $9,900 extra. So again, getting that taxed at top marginal tax rate at 47%, your tax becomes $122,150. So roughly speaking, 122,000. So in one scenario, you are paying 117,500. The other scenario, you are paying 122. So roughly the difference is coming around $4,653. So essentially, this is going to be your difference between the previous scenario and the new scenario, right? So now the real question that you need to be asking, is that significant enough for you to be worrying and changing your investing plans? The second thing I wanted to discuss was regarding negative gearing. So we have again taken a similar example. The purchase price is $500,000. Again, we are taking an example of 80% LVR where we have paid the deposit of $100,000 and some additional buying cost. So you end up paying $124,400 as a purchase cost. And then interest rate for this investment we have considered at 6.5%, which is, I think, reasonable and you can get it. Property management fees are just included as 5%. So the rental for this property we have considered as $500 per week. So the gross rental for the year comes to around $26,000. And the total expense for the year is sitting at, because we have factored in insurance, council rates, property management, and mortgage, the interest payments. So your total expense for the year is sitting at $30,703, right? So you will be negative by $4,703 in this particular scenario. So before the changes, what it meant is that you were able to claim this back in taxes. So say, for example, if somebody is being, like, even considering the best case scenario where you were at 47% tax slab, so you would have saved 47% of this in taxes, which means you would have got that as a tax back from the taxman, which means if we give, we are probably talking $2,200-$2,300 here, right? So now this $2,200-$2,300 doesn't get, you cannot be claiming it against your active income for that particular year, but the losses keeps getting accumulated. So, and you can claim this, or you can offset this by the gains that you'll be making when this property becomes positive. Then you'll be claiming that against that profits before you start paying taxes, right? And we'll see how quickly it can become positive. So for your year number one, let's assume you're renting it for 500. On year number two, you rent it, the rent increases to 550. It just gets down to 2,200. And then in year two, after year 2 years, the rent goes to 600, you become positive. And we are assuming that the interest rates have not dropped until then, right? So in 2 years, you get into a positive gear territory. And by third year, you will be offsetting all the losses. So what essentially you are doing is just a few $1,000s which you could have offset in the same year, you are deferring that for 2-3 years. Essentially it is only that, right? So again, you need to be now looking at a broader picture if your intention is to have capital growth, because real estate investing, your primary goal is always capital growth, because capital growth is what makes you wealthy. Cash flow is for sustainability. So here all you're doing is deferring your few $1,000s of loss to next few years till the time it starts to become positive. So again, not much of an impact, more like it's just the headlines. I hope this helps and helps you in decision making. Good luck with your investing journey, and I hope you take the best financial decisions now knowing this.